Okay, guys, we're going to go ahead and get started. And we are going to be looking at Chapter 7 and Chapter 8 tonight. That's the game plan. Look at Chapter 7, Chapter 8 quizzes. I'm calling those quizzes practice midterms, whatever. Yeah. Yeah. Yes or no? Okay. 7 and 8 are up there? Okay. Okay, so the 8 went up there kind of late, but sometimes I forget to hit publish. I put the slides up there and then I don't hit that little publish button in it's, what do you call it, Canvas. But everyone can see them now? 7 and 8, okay? So we're going to go through the slides for Chapter 7, quiz for Chapter 7, practice midterm, whatever you want to call it, Chapter 8, right? That's the game plan. And if we do that, if we can accomplish that, that then leaves us next time to go through the reconciliation. The government went wide to the fund financial statements and then do our midterm prep, right? Okay, so we should be in good shape for our midterm then the time after that. Okay? Okay, so and then the midterm is going to be on what? 5, 6, 7, 8, and the reconciliation. Yes, sir.
Are you going to go over the Chapter 6 quiz too?
Oh, we didn't go through the Chapter 6 quiz?
I don't think so.
Oh, we didn't? Oh, okay. Well, I guess we better add that to the agenda then. So let's go ahead and let's find that Chapter 6 quiz. This one? Okay. Okay, good. So let's go ahead and let's take a look at this one then. And well, that's big enough, right? We don't need to make that any bigger. Okay, so let's go ahead and let's take a look at this first one where the company is going to, the government is going to issue some bonds, right? And they sell some bonds for $5 million, 20-year general obligation bonds on October 1st. Interest is payable at a rate of 5% a year on the unpaid balance of the debt every 6 months commencing with what, March 31st, 2014. So that's pretty much 6 months, isn't it? Okay, from when they issue them. How much should the city, easy for me to say, report on interest expenditure in the debt service fund at December 31st, 2014? And you take a look at that, and this was sort of the trick question that I don't know if it's a trick question, but the question that I had alluded to before, that the answer would be 0 here because we do not accrue interest in between interest payment dates, right? Okay, so that's actually a pretty easy question if you know that. Okay, okay, good. So you come over and you look at this number 2 now, and the city keeps its books on a calendar year basis. April 1st, 2013, the city sold bonds of $500,000. 6% general obligation bonds payable semi-annually. The first installment is due on October 31st, 2013. Covered interest is $15,000 and principal of $25,000. For the year ended December 31st, 2013, how much should the debt service fund report as expenditure? And so what's happened? Well, they paid amounts what? In October of 2013? Okay, in October 2013, $15,000 was interest and what? $25,000 was principal, and out of the debt service fund, those amounts that they paid during that year are both considered what? Expenditures, aren't they? So the whole amount is $40,000. And again, you're saying, well, wait a minute, but they paid on October 31st. Shouldn't we accrue interest for the balance of the year? Don't accrue interest, right? Debt service fund? Okay. Okay, good. So you see, guys, why I harp on, and I'm preaching to the choir here, why I harp on coming to class, because this stuff can be easy if you're just kind of, tracking with the whole story here. If you come in and you just start trying to figure this stuff out at the last minute, you're like, what the heck is going on here? One time they took the interest, then they didn't. What are they doing, right? Okay. Okay, good. Now, number 3, when bonds are sold at a premium for a capital project, the premium amount generally is what? Transferred to the debt service fund. And, I'm labeling this as Chapter 6. We could have done this in Chapter 5. I think we saw this as well, right? Where we transfer the money out of the debt service fund and into the capital project fund. Actually, I think in Chapter 5 we made it a due to, didn't we? You could do it either way. You could say, hey, it's going to be another financing source to the capital project fund, and then the capital project fund will transfer it. Or when we get that premium amount in, we could set it up as a due to, and then it's a payment of essentially like a payable, right? Right? Okay. Okay, good. Come over and let's take a look at number 4. The City of Harrison, fiscal year end, December 31st. On July 1st, 2014, the city issued $1 million of 6% 10-year term bonds with semi-annual interest payments due on July 1st and January 1st each year, beginning January 1st, 2015. So we're going to make a payment, what? First payment January 1st, 2015, right? What amount of expenditure should the city record in the debt service fund for 2014 and for 2015? Well, 2014 is easy because what? We're not going to pay anything, right? And then what? The first payment, though, is going to happen that next day, essentially, isn't it? And what? January 1st, 2015? So there's an amount that goes out on January 1st, 2015, that if we were doing accrual accounting, we would have accrued that in what? 2014, wouldn't we? But that first, what is it? I guess we got to do the math on this too. It's $1 million, right? Times what? Times 0.06 times what? Times the 1/2 for the semi-annual payment. So that first one's $30,000. Right? And then we make another payment 6 months later, what, on July 1st in 2015? Okay, so I'm just writing the July 1st payment over here. That's another $30,000. And then from July to December, of course, we don't accrue interest if we're in the debt service fund. So the total is what? The June and July payment of $60,000 in 2015? See how easy these are? Piece of cake, right? Okay, but you got to kind of understand the rest of the backstory that we've been talking about. Okay, good. Cedar City issues $1 million 6% revenue bonds that were issued at par on April 1st to build a new water line for the Water Enterprise Fund. Interest is payable every 6 months. What amount of interest expense should be reported for the year ended December 31st? And this is, a little bit premature. I mean, after we've done Chapter 7, this is an easier question because we're going to have studied the Enterprise Fund. But you really should be able to answer it now, and that what? We're using what type of accounting in the Enterprise Fund? Full accrual accounting. So you're like, well, I got to treat this just like I would in my intermediate accounting, right? Or even accounting 20. Business 20, right? We're going to treat it that way. So what happens? We sit here, and since it's a what? $1 million bond, what's the interest rate? 6%. How many months was it outstanding? You count on your, They issued it on April 1st. All of April, all of May, all of June, all of July, all of August, all of September, all of October, all of November, all of December's 9 months, right? When I was studying for the CPA exam, I'd be sitting there going, 1, 2, 3. My dad's like, we're going to be in a CPA that counts on his fingers? Yes. When I'm dealing with months, I'm counting on my fingers to make sure I don't mess up, right? Okay, why do you think God gave them to me? Okay. Of course, my dad's probably sat there and said, I gave them to you. Okay, so anyway, so $1 million times what? Times 6% times what? times the 9/12 gives me 45,000. Just using full accrual accounting, right? Okay. Again, guys, I mean, almost this whole class comes down to what? Grasp, see, Pappy. I mean, if you know that, you can almost answer anything in this whole thing, can't you? And then you just got to kind of add on a couple other stupid rules on top of that, and you're done. Okay? All right, good. So let's go ahead and did I say it right? Grasp, see, Pappy, right? Okay. This whole class comes down to go fly a rock, huh? Okay, grass seed Pappy. Okay. Now what happens? General fund of the city of Castle Rock transfers 150,000 in debt service fund for 100,000 principal and 15,000 interest payment. The recording of the transaction would include, and it is going to be what? Credit to other financing sources and interfund transfer in the world's longest sentence. In the debt service fund, right? Other finance source, basically, transfer into the debt service fund. How about if I ask you for the general fund? Then it's going to be a what? Debit to other financing uses, transfer out, right? Credit cash. And in the debt service fund, we're debiting the cash, right? Is the other side of this entry, right? Okay. Okay, good. What is this? The same question again? No. The general same facts. The general fund of the city of Castle Rock transfers 115,000 to the debt service fund for 100,000 bond principal and 15,000 interest payment. Subsequent payment of the principal and interest are both what? Debit to expenditure. So the money comes in, and then it gets paid out of the debt service fund by debit to expenditure, credit to cash, right? Right? Okay. Why so silent? Could I explain it one more time? Well, give me the journal entry in the debt service fund when the money comes in. The question before it. Money comes into the debt service fund. Let's do the whole transaction. General fund, money's going out. Journal entry. Money's coming out of the general fund. Journal entry. Money's coming out of the general fund. Huh? Okay, there are two other financing sources transfer in long-term debt financing. Okay? There's one other financing use, which is a transfer out, right? So is this money coming out or is it coming in? The general fund. General fund coming out. So what's the journal entry? Huh? Okay, good. Debit other financing uses. Transfer out. For what? Did they give me an amount? 115,000. Okay, good. What's the credit? Credit is to cash because the money's coming out. Okay, good. Now how about in the debt service fund? Same transaction. Debit cash, 115,000, right? Because the cash is coming in. Give me the whole title. Credit other financing sources, transfer in, right? Okay, good. For 115,000. Now, was the debt service fund given that money to look at it? What was it given this money to do? To use it to pay the principal and interest, right? And so when I pay principal and interest, what journal entry do I make? When I pay principal and interest, what journal entry do I make? I'm going to go ahead and I'm going to debit expenditure because the debt service fund is doing its job, right? And when a fund does its job, we go ahead to see that that money was spent for the intended purpose. We debit expenditure, right? And we credit what? Cash, because it's paying the cash. You bet you. If you bought bonds, you want your interest in principal in cash, don't you? You don't want me to credit pigs, do you? Okay, you want cash, right? Okay. Okay, good. Okay? Okay, so that's that journal entry. Okay, good. Number 8. Okay, the city of Spartan's fiscal year end is December 31st. On September 1st, 2014, the city issued $1 million of 6% 10-year term bonds with semi-annual payments due on March 1st and on September 1st each year. Beginning on March 1st, 2015, what amount of expenditure should the city recognize in the debt service fund? I kind of read the cadence on that wrong. Let me read that second sentence again. On March 1st, 2014, the city issued $1 million 6% term bond with semi-annual interest payments due on March 1st and September 1st year end, beginning on March 1st, 2015. So the first payment is going to be March 1st, 2015. Okay. Then what? What amount of expenditure should the city recognize in 2014, 2015? Well, 2014 we know is going to be what? 0, because they haven't paid that amount. Is that the same question? Little different fact, but almost the same question. It's 30,000 and an amount is paid in March, 30,000, and then an amount is paid in what? September for 30,000, right? So that gives me 60,000 total for 2015. Right? Okay. Okay, good. Which of the following assets would not be found in the balance sheet of the debt service fund? I could have put this same question, guys, in chapter first midterm, chapter 1 and 2, whatever, right? Full accrual, modified accrual accounting, right? No fixed assets. And that's what's used by the debt service fund, right? 10. Debt service funds are used to account for which of the following? Principal and interest on general long-term debt. It's both of them, right? It's not all debt of the government, because if the debt is being issued out of the enterprise fund, out of the internal service fund, if it so happens that one of the proprietary funds issued debt for whatever reason, then that's going did I say proprietary funds? Out of the fiduciary funds, the first two I mentioned were proprietary funds. Out of any of the fiduciary funds, for any reason, they account for their own long-term debt, right? It's only general obligation debt. Debt issued by the capital project fund, by the general fund, maybe by the special revenue fund, whatever. Permanent funds don't typically issue debt because what? They get that principal up front, and then they just have to maintain that principal, right? To operate. Okay. But if any of the other funds issue debt, then that's going to be accounted for. Any of the other governmental funds, that's accounted for out of the debt service fund for the payment of principal and interest. Debt that is specific to one of the proprietary funds or one of the fiduciary funds is accounted for in that fund, right? Using full accrual accounting. Okay. Okay, good. When bonds are sold at a premium for a capital project, the premium amount is generally... Didn't we already have this? Starting to have deja vu, I thought for a second. That's medium difficulty? I don't think so. Only thing that's difficult about that is remembering if I've given you the same question already. Okay? All right. The city of New Haven issued 20 million tax-supported bonds at 1 and 2 to finance a new prison. Great. Upon issuance, how will the premium be recorded? So I guess we got to figure out the premium now, don't we? So 20 million times what? 0.02 is the premium part of that, right? Huh? What's that come to? 400,000? Okay, good. So there's a premium. So we know we got the 400,000, and that did us no good at all because every choice has 400,000 in it, right? So I thought maybe we could get rid of some of these, but they all have 400,000, right? Okay, but at least we know that amount. And then what? You take a look, and they say a 400,000 other financing source to the debt service fund and 400,000 premium on the bonds payable. I see in the governmental activities, right? Governmental activities, that's a premium, isn't it? You don't report a premium in the capital project fund. That's other financing source. Or again, we could see, like we saw back in chapter 5, they set that up as due to the debt service fund. Either way, it's ultimately going back to the debt service fund either through the payment of a payable or through a transfer out, right? It's going to end up in the debt service fund, the premium. Right? I'm sitting there in the debt service fund. Two options as to how I'll report that. Let's just go ahead and put that in writing. Two options in the debt service fund as to how I'll report that premium. So in the debt service, let's say the who issued this debt? Did they tell us? Well, to finance a new prison must be the capital project fund, right? So in the capital project fund, I'm going to debit cash for how much? 2,400,000, 20,400,000, something stupid like that. Debit the cash, right? And I'm going to credit, and my options are I could credit other financing sources, bond principal for 20 million, and credit what? Other financing sources premium for 400,000, right? Right? Okay. Now, what happens? I sit here and I'm still going to send that money over to my buddy, the debt service fund. So the debt so in the capital project fund still, I'm going to go ahead and do what? I'm going to debit, transfer other financing uses, transfer out to debt service fund 400,000, and credit what? Credit the cash good for the 400,000 that's going out to the debt service fund, right? That's option 1. Okay. In the what? In the debt service fund, of course. Meanwhile, back at the debt service fund, I'm going to sit there and debit cash for that 400,000, right? And credit what? Other financing sources. Good. TI transfer in for 400,000 because that money's coming into the debt service fund now, isn't it? With me so far? Okay, now all I'm saying is that option 2 would have been for me to, when I got this cash right here in the capital project fund, option 2, I still have to debit cash. There's no option that gets me out of debiting cash for the 20,400,000. Credit what? Other financing sources, bond principal for 20 million. And then credit due to debt service fund for 400,000. Right? This is option 2. The cash still gets in the debt service fund. The cash still comes in, and all I've done is I've set up a due to the debt service fund, right? Right? Now, in the debt service fund, at that point, they may go ahead and debit due, from capital project fund for what? 400,000, and credit other financing. Debit due from and credit. What are they going to credit here? Credit other financing sources. It's not transfer in. It's going to be what? Bond premium. Because that's really the source of that money is the bond premium, right? And then when the capital project fund sends the money over, capital project fund's going to do what? Capital project fund is going to sit there, and they're of course going to debit the what? Due to debt service fund for 400,000. Credit the cash. And the debt service fund is going to do what? Debit the cash, 400,000. Credit the what? Due from capital project fund for 400,000. So under option 2 here, it sort of gets treated as like money that was like paying off a loan, isn't it? Almost. Where we had what? We had money that was due from, and we just simply waited for it, and then we went ahead and credited the cash, debited the due from, and we accounted for the other financing sources as money coming really straight into the debt service fund, right? Okay? Okay. All right, so that's all I was saying before. Question? Yeah.
Why are we doing due to debt service fund? The last one, the entry you did, 400,000.
Because I felt like it. I don't know. 2 different ways to account for it. Get you to the same place. I mean, either way, cash went over to the debt service fund, didn't it? Okay, and in one case, we accounted for it as another financing source that went into the debt service fund from the bond premium. In the other case, it was another financing source from a transfer in from the capital project fund. I guess it depends on the way the bond covenant reads and how restrictive it is that we're supposed to do with that premium. But in this class, you can always, assume that we're going to default to sending whatever the money is over to the capital project fund. I mean, that's the takeaway of those couple of questions we had where we did that. I mean, to the debt service fund. Okay? Okay. Then if there's no further questions on that Chapter 6 quiz, we can go ahead and jump ourselves to Chapter 8, right? Because we were done with Chapter 7? Okay, so we can go ahead and we can go to Chapter 7 now, right? Okay. Okay, good. So Chapter 7 is going to be accounting for our proprietary funds. So it's basically going to be what? I don't know why we're calling it business type activities, because it is both our enterprise fund and what? And our internal service fund, right? We're going to account for both of them here. We're going to deal with both of them here in Chapter 7. Internal service fund activity is a governmental activity, right? Only the enterprise fund is the business type activity part of this. Okay? Okay, so let's go ahead and let's take a look generically at proprietary funds. Both our enterprise fund and our internal service fund will have 3 categories of net assets: restricted, unrestricted, and invested in capital assets net of related debt. Those are the same three categories that what? That we looked at when we were talking about the government-wide statements, right? And remember I had given you the mnemonic what for this? Run. Three categories of fixed assets. Those three categories of net position. Those three categories are the same at the government-wide level. They're the same for the enterprise fund. They're the same for the internal service fund, aren't they? Same three categories? Hello? Okay. Okay, good. Let's take a look here. Okay. We are not going to be using budgetary accounting here. Yay, right? No encumbrances, no appropriations, none of that. We leave all that at the door, right? Isn't that wonderful? Okay. Okay, good. We are going to have depreciation expense, though, because now we're on full accrual accounting. So as we have these fixed assets that are reported in these funds, we're going to have to depreciate them, right? So we'll see the full amount of depreciation expense. Okay. So we come over, and we're going to have three financial statements now. All along through our governmental funds, you kept hearing balance sheet and statement of revenues, expenditures, and change in fund balance. You got tired of hearing me say it, right? Balance sheet, statement of revenues, expenditures, and change in fund balance. We said it over and over again for all five of the governmental funds. For our two proprietary funds, we're going to have what? We're going to have our statement of position, which is the balance sheet, statement of net position, which is the same name we use for the government-wide balance sheet, isn't it? When we get to the income statement, we don't call it the statement of activities like we do at the government-wide level. We call it the statement of revenues expenses, because we're on full accrual accounting, and changes in fund net position, right? But that's the income statement, okay? And then we're going to have a statement of cash flows. And this is the major part of Chapter 7 lecture for you to get used to some of the things that we do unique with the statement of cash flows for a governmental proprietary fund, or in other words, our internal service fund and our enterprise fund. Now, we say statement of cash flows differs under governmental accounting standards board requirements, but frankly, we could also say that it is similar to what we would do in commercial. You guys studied statement of cash flows, right? Okay, so it is very similar to the commercial format, but there are some important differences. Okay, so let's take a look. We have our, we'll get to that later. Sorry, I get all excited about statement of cash flows, but our net position, we already know, is divided into three categories. What? Net investment, restricted, and what? Unrestricted. Note to self, who cares? Take that slide out. That's all I want you to know about that, is that there's three categories. Okay? Okay, good. Now, when we look at our operating statement, we have our revenues and our expenses, and we'll categorize them as what? Either operating or non-operating. Does that sound familiar? Okay, so operating is going to be normal course of business type things. Non-operating, classic example, interest revenue. Interest expense is non-operating, right? Just like you would in commercial. Okay? Okay, good. Now, let's take a look at the statement of cash flows. GASB and FASB are very similar in how we prepare the statement of cash flows. However, there are key differences that are right here. And the red ones are ones that I put in because the book didn't call them out, and I guess I wanted credit for calling them out, so I put the words in red. Okay, but anyway, I don't have no idea why I put these in red. All right, but let's take a look. How many differences do we see here? 1, 2, 3, 4, 5, 6 differences. Well, that means we need some numbers on these. 1, 2, 3, 4, 5, what? 6 differences that we're going to mess with here. Okay, so now we can even number the differences. Isn't that going to be helpful to remember? Okay, so what? When we deal with our Statement of cash flows for GASB purposes, we take the financing activities and we break them into capital and non-capital. So when you prepare this statement, you're going to have what? 4 categories instead of 3. 3 like you would in commercial. Commercial, you have operating, you have investing, you have financing, right? Right? Okay, we're going to have 4, and then we're going to take the financing and we're going to break it into 2 separate categories. If we borrow money to acquire a capital asset, then that's going to be what? That's going to be financing activities for capital related. If we borrow money for an operating loan, that's what? Non-capital related financing, isn't it? Okay, so we break it into those 2 categories. Okay. Number 2, acquisition of capital assets is a capital-related financing transaction. Remember, this is comparison to commercial. In commercial version of statement of cash flows, you acquire a fixed asset that is investing, isn't it? In the government, it's financing. Now, you sit there and you say, what did they just sit around and say, what are they, like some sort of dictator that says, all children who were not previously 12 years old are now 12 years old, right? They just came up with something that because they're the dictators, because they're GASB and they can, okay? What happens? That's an old movie where there's this movie about this guy who's supposed to be a great, person that's going to lead the country into freedom and stuff, and then the power all goes to his head, right? And then the next thing you see him making speeches, and he says, all children who were not previously 12 years old are now declared to be 12 years old. Okay, so anyway, because he's losing his mind with power, okay? So anyway, so what happens? So we sit here, and we do what? We treat it as financing, and the reason they do this is that when a proprietary fund like an internal service fund or an enterprise fund acquires an asset, usually there's been some sort of financing that was provided for that, right? It's not like they just got all this cash laying around and they just went ahead and spent it on this equipment, right? Typically they've issued bonds or they've had some amounts transferred over or something, and so GASB determined that whole amount that whole transaction should be reported in the financing section. Okay, so when you acquire equipment, it goes where? Financing activities. Okay, not investing. Okay, number 3, interest expense on long-term debt will be classified as what? Either a capital related financing activity, rather than what? Operating. Now, I look at this, and this to me is an improvement over the FASB version. FASB version puts what? Puts interest expense and interest revenue up in the operating section, don't they? And the reason they do that is because they want to start with net income and end up to cash provided by operations. And so it's easier for you to do that reconciliation down there by starting with net income and then dealing with your interest expense and revenue up there as an adjustment to net income. But it's really confusing. It's oxymoronic if you think about it, in that what? When we're preparing our income statement, interest expense and revenue is considered non-operating, isn't it? So isn't it a little stupid for FASB to say, well, include interest, revenue, expense up in the cash provided by operations? No, it's not part of cash provided by operations. It should be down in a non-operating section, in the financing or the investing section, shouldn't it? But if they do that, then they can't reconcile net income to cash provided by operations. They'd have to reconcile operating income to cash provided by operations, and they don't want to do that. They want to reconcile net income to cash provided by operations because the users of financial statements, we understand net income. We get net income, and now we want to know the cash. Okay, well, what else? Anything else you want us to do for you? You want us to make you a sandwich? We start messing the whole thing up just to please these users that got a C in Accounting 100, All right, so anyway, that's sort of what's going on with FASB. GASB says, we're not playing that. We're doing this thing right. You either have what? You either have interest that you've what? the interest expense on. And when we put it in the financing category, if it's a what? If it is a loan to acquire a fixed asset, it's interest from capital-related financing. If it's interest from an operating loan, it is interest from non-financing activity, right? Okay, and so that's why I added that. I added number 4 here. Who cares who added it, John? Number 4, shut up. Who cares if you added it or not? Interest revenue is considered what? Investing rather than operating. If you get interest revenue, it's going to be investing, not operating like it is in the commercial version, which is stupid for them to put it up in operating, the commercial version. And then what? Cash flows from operating activities must be shown using, and that's a big one, direct method. You have to use the direct method. If you look at FASB, what they say in Accounting Standard Codification Section 230, somewhere in there, they say that they would like you to use the direct method, but they allow the indirect method, and what do all the companies choose? Huh? What do all the companies choose? Even though FASB prefers direct, all the companies choose indirect, right? There's studies that are done, and they look at a bunch of financial reports, and they find that like 89% of the time, companies, I just made that number up, use the indirect method. Why do they use indirect? A lot of times students tell me it's easier. Yeah, okay, that's maybe part of it. But let's face it, CEOs and CFOs don't sit up there and say, what will be the easiest thing for our employees to do? And let's just do that, right? That's not how they decide what method to use, really. Why do they use the indirect usually? Huh? The income will what? Not really, no. Tax is not relevant to it, really, to me. I'm not a tax guy. I mean, some of you might have had some tax person that went on and on about the tax consequences of it. If there is a tax consequence, I'm not aware of it. That's not what I'm thinking anyway. So can't you read my mind? Let me tell you what I'm thinking, okay? What I'm thinking on this is what? I'm thinking, and what I've seen discussed, I just make this up, is that companies get a little scared to report to their competitors what was the cash they received from their customers, what was the cash they paid to their suppliers. This can be what? This can be sort of proprietary in nature, and so FASB allowed for the indirect method, right? Okay, governments don't have this competition issue to worry about. So GASB said, forget about the indirect method. You must use what? You must use direct. And FASB would like companies to use the direct as well, but a lot of them use indirect. Most of them do. Okay, large percentage of them do. Then what? We still have to provide the reconciliation even in the direct method, and if you're a commercial enterprise, it's net income to cash provided by operations. So if you're a commercial enterprise and you so happen to choose the direct, you still have to show the reconciliation of net income to cash provided by operations. Okay? In the commercial version, we're not going to reconcile net income, we're going to reconcile, and to me they're doing it right, reconcile what? Operating income to cash provided by operations, and that makes sense because my interest, revenue, and expenses are appropriately placed in their investing and their financing, capital-related or non-capital-related financing, right? Right? Okay. Okay, so you take a look at the next slide, and this is a little hard to see, okay? But the main thing, read this whole thing carefully. Okay, that's not what I want. The main thing I'm trying to focus on right here is this is basically first, guys, this is my statement of cash flows, right? Statement of cash flows, and they're using the direct method, right? And they have what? They have cash flows from operating activities using the direct method, cash flows from non-capital related financing, from capital-related financing, cash flows from investing. There's my 4 sections, right? And then what? And then I'm supposed to reconcile, and if this was the commercial version, there'd be a reconcile from net income to cash provided by operations. If I'm using what? If I'm using the government version, it is what? Reconcile operating income to cash provided by operations, right? Isn't that what they're doing there? Okay. Now, where are they picking up that operating income? And that's what this little side-by-side comparison was supposed to do. Over here, I have my proprietary fund statement of revenues, expenses, and changes in fund net position. And of course, notice I'm using a commercial format for that. Operating revenue, operating expenses, and then I have what? Non-operating revenues and expenses where my interest and stuff is, right? Just like you would in commercial. Right? And if you notice over here, you see that operating income number, the 120, the 235 for my two enterprise funds, 355, and then 25,000 for my internal service fund. See the operating income right here? Right here, operating income. See my operating income right here? Where is it? Operating income. Right here. See right there? See right there? Okay. And so when you come over to the statement of cash flows, isn't that those same three numbers? We start with operating income and we reconcile to cash provided by operations. Right? Okay. So we've got what? So we've got 6 differences, don't we? 6 differences. Gotta use the direct method, right? Instead of 3 sections, we have 4 because we've taken financing and we broke it into what? Capital and non-capital related financing. Good. What happens? Interest revenue and interest expenses. Interest revenue is part of investing, not operating. Interest expense is part of non-capital or capital related financing, not operating, right? Okay. When we purchase equipment, we do what? We put it in the financing section, not the investing section. And then what? And then you go ahead and when you do your reconciliation, you reconcile not to net income to cash provided operations, but what? Operating income. Okay. Now, when I teach my CPA exam students this, what I tell them to do, and we're not going to get into a full-blown problem, you're going to see the nature of multiple choice questions that we're going to do in here, although I will give you sort of a full-blown problem to practice with for your homework. And the full-blown problem that I give you to practice with is because in my dream, what I would tell my CPA exam students to do, not in a dream, in real life, I would tell them to just pretend like if they got a statement of cash flows for government, because people panic when they get that, I tell them just pretend like you're preparing a commercial one, and when you come to one of these differences, do the government thing for that, and then go back to what? Acting like you're preparing a commercial one, right? Because it's really down to these 6 differences. And then I had a dream that a student told me, because you're not supposed to tell me what's on the CPA exam. So no student has ever walked into class and said, hey, guess what was on my CPA exam? But in my dream, a student came in and said, hey, guess what? This was on the CPA exam. And in the dream, they told me that all we had to do was take the changes in cash affecting different things and just categorize it correctly on the statement of cash flows as to whether it was operating, investing, financing, etc. Okay? And so what I did after that is I went ahead and I made this slide for my CPA students that tells them what? If you have these different things, these are the categories that you should put it in because of the dream I had, so that they would memorize this and then they would know. And that makes that a very easy task-based simulation, because all you got to do then is just take the numbers that they give you that should appear in these different categories and categorize the thing, right? Okay, so I'll give you an exercise like that to do later. I don't know, maybe as part of the practice midterm or something. But I figured I'd stick this in so you could look at it. Okay? Okay, question? Okay, that's the big thing, statement of cash flows, and we'll see how that information is going to shake out in multiple choice question for you, and when we look at the practice midterm in a minute. So now, in a little while, I just want to get us into some of the detail about the two proprietary funds. So we were just talking generically about them, right? Now we're going to talk specifically, starting with the internal service fund and then moving over to the enterprise funds, okay? So internal service fund, classic example is motor pools, right? Does the city of San Jose own vehicles? Don't get one behind you tonight when you're going home, right? Okay, so police cars, fire trucks are city-owned vehicles, aren't they? And so they take those to a central motor pool to be worked on, don't they? And so the customers of the internal service fund are the other governmental funds, aren't they? Okay, and so what happens? Something I heard, I don't know, I could be wrong. I heard that this information is easier to understand if your eyes are open. That's what I heard, okay? Now, I could be wrong, and I know I have a face for radio, okay? But, let's try to maintain, okay, and take a look at this. Okay? All right, so what happens? I know it's exhausting, guys, but I'm not going to sit there and let you sleep. I'm just not going to do it, okay? It's just not worth it to you, and it annoys me if somebody starts getting into rapid eye movement in the middle of my class. So I'm just going to have to wake you up, okay? All right, so we have what? We have these motor pools sitting here as a classic example of internal service fund. The customers are what? The other governmental funds, aren't they? That's why when we roll up the financial statements, by the way, I did reach out to MG&O. They're not coming because they said they're just really swamped. I figured that was the case. This is their busy season. They said they will come next semester. Good, lucky for you. But if you want to come to that, you can. I'm sure there'll be room for people to come. I'll keep you apprised if you want to stay in contact. Somehow I'll keep you apprised that they'll be coming next semester. But I'll go through some of the things they would have said. But it won't be as interesting, okay? So what happens, you're sitting here and you have these motor pools, and when we report the government-wide level or any internal service fund, it's in the what? Governmental activities column, right? Okay? Okay, good. We have these different things. Now, when we take a look at the internal service funds, all they are trying to do is cover their cost. They are not there to generate a huge profit off of the other governmental funds, obviously, right? And I told you the story in here about when I was on an audit where our whole procedure was to take a sample of government's internal service funds and see if they were reporting. At that time, they called it retained earnings instead of net position. They literally called it out as retained earnings, okay? So we analyzed the retained earnings to see if we saw any internal service funds ratcheting up a large retained earnings in the internal service fund, because that meant to us that they were charging the other funds for a profit, weren't they? And the other funds do what? They get money from the federal government to pay for these services. So they were charging the federal government profit, and profit is specifically legislated as an unallowable cost. They can't include a profit margin in there. And so we went back after them, and we actually had some recoveries, and it was kind of like, the world's greatest audit where you get all these nice findings, because we just went down the list from the number one and we just picked off the top, right? Until we decided, okay, we think we got a big critical mass here. Let's go ahead and start looking at these, and we started to recover some money that way. So that is something that shouldn't happen. They shouldn't build up a big net position because they're just trying to what? Cover their costs, right? Okay? Okay, good. So you come over and you take a look, and they have their revenue. The revenue account for internal service fund is called billings. Be careful with that, because I always point that out, and I put that in red up there, and then I put that question on the test, and everyone misses it. No one can remember what the name of the revenue account is that is used by the internal service fund. It's called what? Billings. Billings for mechanic services, whatever it is, right? Okay. Okay, good. When we talked about major funds back in chapter 2 or whatever it was, remember we looked at what? We looked at our governmental funds and we looked at our enterprise funds. We did not include in the analysis internal service funds. I'm neither reminding you or telling you here. I don't remember if we mentioned it then. Internal service fund can never be a major fund. It's just the governmental funds and the enterprise funds that we analyze for major fund criteria. Okay? Okay. And again, we've said that the internal service fund is part of what? Governmental activities column at the government-wide level. Okay? Good. Enterprise funds. Okay? Now, they say that an activity should be treated as an enterprise fund, and it's these two categories. If these two particular situations, if the activity is financed with debt that is secured solely with the revenue of the enterprise fund. Okay, what happens? Do you think people need water? Okay, we need water, right? Okay, so what happens? If you had a water enterprise fund, would you be willing to give them bonds, sell them bonds if you knew that the revenue, that it was backed by the revenue from water? Right? That's about as secure as a loan you're going to get. You know there's as secure as a loan you're going to give, right? If you're purchasing bonds, you know that they're going to generate revenue from water. I mean, unless the drought gets really out of control, and then who cares about bonds, right? Okay, but what happens? You know that they're going to generate revenue from that water for the water bills, aren't they? So that's a nice little secure bond for you. And if the If the activity is financed with debt that is secured solely with revenue from that activity, you account for that as an enterprise fund. The other category is if the law or regulation requires the cost of the activity to be recovered with revenue from the activity rather than taxes or other revenues. Now, what does that mean? Remember we had this little thing? Remember this little drawing? I guess I should put the drawing on the recording in case, because everybody, the millions of people that will be watching this later. I noticed, like, when I first started doing these, I'd get like 80 people watched it. Now I'm looking at the thing when YouTube says how many watched it, and it says 2. And I'm like, oh, that's right. I did look at it that second time. Okay. So what happens? You come over and you take a look at this thing. This must be why no one watches it, right? Or this is the comedy part, or everyone just fast forwards to these parts. What is wrong with this thing? Oh, that's frustrating. I don't understand why Microsoft can't make this more user-friendly. Why do they have to make it such a pain? What is their point? Okay. Why is it doing? Why is it hiding? Why is it hiding the arrows from me and the pens? Huh? I can't see the arrows or the pens. Well, it's not there when I'm in tablet mode, which is when I want it. Okay, there it is. It wasn't there a minute ago. Okay. So what is this thing? That's a road, okay? And what happens? We need money to run the roads, don't we? Okay? So if we have a gas tax, we could use that gas tax to run the roads, couldn't we? Right? Okay, maybe we report that gas tax as a what? As a special revenue fund of some sort. The revenue is the gas tax. The use is what? The intended use is going to be to make road improvement and stuff. But what happens if in addition to gas tax, there's also this big box up here, which is a toll. Now, we don't have toll roads in California, but if you go to Florida, they have toll roads. If you go You go, 8 miles down the road, here comes another toll booth, and you got to throw, 78 cents in there. And then you go down another, 2 miles, and you got to stop again, and you got to throw 43 cents into the toll. And I'm like, when is this going to stop? This is crazy, right? And you keep throwing that money in, right? So that's why people always say, oh, yeah, move to Florida. There's no state income tax. Meanwhile, you end up throwing all that money in, 40 cents at a time every 2 miles down the road. Okay? So what happens? We sit here and we have these tolls, right? Now, the toll is the bigger box here, isn't it? They're getting this gas tax, but the toll is the bigger box. Okay? So for this particular case, this road would be accounted for as a what? As an enterprise fund, because what? The revenue for the activity is coming from the costs are being recovered for the activity through revenue rather than what? Taxes or other revenues. It doesn't mean that they can't get other revenues. It just means that what? The majority of the costs are financed by what? By revenues. That constitutes it being an enterprise fund, right? So either what? Either the money for this activity was financed by bonds that are based on the revenue, or what? The major source of funding for this activity is the revenue that is charged for the use of this, right? Right? Okay. Okay, good. So you come over, and by the way, if you're preparing the enterprise funds statement of revenues, expenses, and changes in fund net position, we are going to have tolls. Tolls are considered normal course of business, so they'll be what? No, normal course of business means there'll be revenue, right? And the gas tax, is that a normal course of business? Is gas tax a normal course of business? Gas tax is not a normal course of business. Their normal course of business is standing there saying, 43 cents, please, sir. And they have to pay the 43 cents. Isn't that normal course of business? And so what happens? Gas tax would be an example of what? Non-operating, right? Non-operating, because that money's kind of just being handed to them from the government. And what often happens is the state will collect that gas tax, and then it'll go ahead and partition that money down to the different counties. And, the part of a state highway that's financed by gas tax that is, in a particular county, you got, 80 miles of that highway in your county, you get a portion based on how many miles of road you have in that part of the county, right? Okay. Okay, good. Now you come over and take a look at the different types of enterprise funds. Water and sewer are the classic example, right? There's our toll roads, bridges. Okay, so somebody could sit there and say, well, look, you're complaining about Florida because you got to pay 47 cents every 3 miles, but at least we don't have to cough up $6 to go 2 miles to cross a bridge and wait in traffic while we're doing it, right? Okay. Okay, so all of these different things would be examples of enterprise funds. Now, take a look, and we're going to sometimes have items that are restricted in our enterprise funds. For example, when you probably, first got your apartment or your house and you had to pay the water bill or whatever, the water company looked and said, we don't know you. We know your mom. We know your dad. We don't know you. Who are you, right? And so since they don't know for sure that you'll pay the bill, they made you put a deposit the first time you opened up a water account, right? And then what? After about a year or so and you pay and you're in good standing with them, they go ahead and they release that deposit to you. And then you can just go forward month to month after that. Well, those deposits are considered restricted funds for the enterprise funds. Okay? Okay, good. Come over, and I guess that's what this is saying as well. This is giving the specific example of customer deposits that would be restricted. Okay, if we issue bonds and the bonds are repaid from the proprietary funds resources, we account for that principal and interest in the what? In the enterprise fund, the internal service fund, whatever. And if it's the what? Revenue bonds, like the water revenue bonds or whatever, we call that revenue bond interest, etc. Did they ever take you to a outing at the dumps when you were a kid? No? Right? Isn't it fun? It's great fun. What happens? You head out towards Milpitas? Sorry. Yeah. I don't know. Every time I get to Milpitas, I start smelling the dumps. I don't know. Maybe it's just a childhood trauma coming back to me. But what happens? I sit there and you go and you get closer and you start getting that smell in the air, right? And then you get to the dumps and what? All civilization ends right there at the edge of town, right? Seagulls are flying all over the place. People are throwing stuff. Bulldozers are throwing the stuff off the side, right? It's a great family outing, okay? So what happens? Now we have this festering hole of garbage here, don't we? See this festering hole of garbage, this landfill? Well, what governments used to do is they would sit there and go, well, that hole is full. That area is full. Let's go on and mess up the next area, right? And all of a sudden, you've got popping up as cities get bigger and bigger. You got popping up all across the nation these huge piles of garbage, right? Well, the federal government had to step in and do something on that, right? We can't let all this smell just go to high heaven and pollute all the water and everything else. So the federal government came down and said, you have to clean that up. You have to clean that up. When you're done making that mess, you're going to cover that thing back up. You're going to install equipment that will monitor any poison gas that could be coming out of that. And you're going to have to put some sort of park on top of that or something so all the little children can go and play properly, right? Okay? And so what happens? Since the federal government mandated that the local governments would do that, GASB looked at that and says, well, if you know you're going to have to spend money in the future to clean this stupid thing up, that is a liability. So what do? They make them take a liability for amounts that they're going to have to pay maybe 20 years from now to clean this mess up, right? Okay? So you take a look at the next slide, and I give you examples of the type of cost that would be involved. Cost of equipment to be installed that will help clean up the mess after we're done accepting waste. Gas monitoring equipment. They have to literally monitor to see if gas is coming out of these things. Poison gas. Do they ever find poison gas coming out? You ever hear about them finding poison gas coming out? They found poison gas coming out of one in Fremont. It's a park now. What hangs out in parks? Don't say bums. What hangs out in parks? You're like, John, you said it. What hangs out in parks? Okay, it's okay. But squirrels hang out in parks too, right? And squirrels were doing, and it was one of those parks where the dump was on top of it, and the squirrels were doing what squirrels do, which is squirrel down, and somehow they were letting the poison gas out, and they found out about it, right? So what did the park officials do? Cut all the trees down? The trees would be sitting there going, what did we do? No, they killed all the squirrels. They just exterminated all the squirrels to stop that from happening. And at first, people were all up in arms that they were exterminating the squirrels until they found out they were releasing poison gas. And everybody's, oh, okay, that's all right. All right, so what happens? They go ahead and they do what they have to do. But they do monitor this, don't they? Okay? Now, what happens? We come over and we have what? We have to cover that thing up, don't we? Put a park on top of it or something. So what happens? All of these costs go into a pool. They have to estimate all these costs, and they put them into a cost pool. And then each period, as they fill up the dump, they do what? They take a percentage out of that pool and debit what? Expense and credit liability as they fill that hole up. So if they sit there and they put $1 million of cost in here, and they fill up 20% of the landfill, what's the debit to expense? Not a trick question. They put $1 million in the cost pool, and they fill up the landfill 20%. What's the debit to expense? Oh, man, you guys are tired. Okay, 20% of $1 million is $200,000, so they debit the expense $200,000. They credit the liability $200,000, right? Right? Okay. All right. What happens if they fill up next year 30% of the dump? Filled up 20% the first year, 30% the next year. Now what do? Don't overthink it, guys. They debit the expense $300,000. They credit the liability $300,000, right? As they go along. Okay, that's all. All right. Okay, so that's how we account for landfill. And that portion of the cost proportionate to the ratio of estimated capacity utilized during the year over the total capacity. That's expense and liabilities, and that we just described there in that little example, that middle paragraph. Right? Okay. End of chapter 7. Huh? You want to take a break now? Well, it's barely even an hour, huh? Yeah, we are. We're going to do chapter 7 and 8. Quiz for chapter 7 is coming after this break, I guess, that we're going to take right now. I don't understand. What is this? So this, okay, it's 7:15, guys. What do you think? It's not 9:15. It's 7:15. So what time does this class get out? Okay, we got all kinds of time. So we're going to go take the break now if you want. And then we're going to go ahead and we're going to come back, look at the quiz for chapter 7, look at the slides for chapter 7, look at the quiz for chapter 8. And we'll get out of here about 10:30. So we're all set. Now, we should be able to get through all that and get out on time. Okay? Do you want the break now or later? Now? How many for now? How many for later? The nows have it. If you abstain, that's why. Okay, so go ahead and take the break now, and we'll come back. We'll do 7:30. We should be okay. 7:30. Okay, guys, let's go ahead and get started back so that we can get through this chapter 7 quiz and hopefully get through the balance of the material for chapter 8. Okay, so let's take a look at this one here. When an internal service fund sends a bill to the general fund, what should we debit in the internal service fund? So if we're sending a bill to the general fund, then we must have provided some service to the general fund, like working on police cars or something, out of the internal service fund, right? And so what are we going to do? We're going to debit due from general fund, say for 10,000. I don't know. They didn't give us a number here. Okay, which is the answer to this question. What are we going to credit? Well, that would be somewhat of a weird entry to debit a due from and then credit cash. Due from is saying that they're owing us cash, right? Huh? Building? Billing. Yeah, right, exactly. Yes, thank you. Yeah, I'm gonna credit what? Billings is the revenue account. Good. Right? Okay. Okay, good. Under which of the following circumstances must an enterprise fund be used? And we had two criteria. C is one of them, when activities are financed with debt that is secured solely by a pledge of what? Revenues made by the activity, like the water bonds. That's right off the slide, isn't it? What's the other potential? The costs are to be recovered through revenues, right? Right? Okay, like that. Doesn't mean doesn't mean all the costs are to be covered through revenues, but the majority of the costs, right, are to be covered through revenues. Okay. Okay. Good. Number 3, proprietary funds sometimes report special assessment revenue. What are special assessments? And remember, guys, we went through last time and talked about what? Special assessment, and who did I make the street lights over here, right? What's your name again, sir? Todd, I made street lights for you. Sorry, I ask your name every time. I made street lights for you, and I assessed you for that, right? So when we have that was an example of a special assessment. So when we have a special assessment, that means we're taxing those property holders that will benefit directly, right? Okay. Okay, good. For fund level financial reporting, a statement of cash flows is required for what? Both of my proprietary funds, right? Enterprise fund and the internal service fund both have to prepare a statement of cash flows. They're the only funds, the proprietary funds are the only funds that prepare a statement of cash flows. Nobody else does, right? Okay. Okay, good. A water enterprise fund issues $4 million 5% revenue bond on October 1st, 2013. The enterprise fund will make the first payment of interest on March 31st, 2014, together with a principal payment of $200,000. What amount of any should the enterprise fund report in the statement of revenues, expenses, and changes in net position for the year ended December 31st, 2013? And now we're going to use full accrual accounting on this stupid thing, aren't we? So the answer isn't 0 like it would be for a governmental fund like the debt service fund. Now it's going to be what? 4 million times, what's the interest rate? Times 5% times how many months? October, November, December, 3 months, right? So it's going to be what? Times 3/12? Does that give us that number? 50,000? Full accrual accounting, right? That's really the point of that question. Okay, good. GASB's statement of cash flows is different from the required in the private sector. In which of these ways it requires reporting operating cash flows using what? Got to use the direct method, right? Number 7, proprietary fund net position must be reported in which 3 elements? What's our mnemonic? Run, there you go, restricted, unrestricted, and invested net in capital assets, right? Net invested in capital assets. And when they say net, they mean net of any debt that you issued to acquire those capital assets. Okay. Cash flows from investing activities include which of the following as cash inflows, and what? Interest and dividends received are going to be considered what? Investing. If I'm asking the same question for a for a commercial statement of cash flows, that's what? Huh? What? No. Interest and dividends received? That's operating, isn't it? Even though it may be non-operating on the income statement, it's in the cash provided by operating activities in the commercial version. So it's kind of screwy, isn't it? The commercial version. Okay. Okay. Good. How about dividends paid for commercial version? Obviously, because there's no dividends paid in the government, huh? That's financing. So they make it even more difficult, right? And then all of a sudden, for the dividends paid, well, that they put down in financing. But for dividend income, if you're using the cost method, you're treating that as investment income, that goes up into the. They need to get it straight. I mean, what happened? Did they fall down and hurt themselves when they wrote that standard? I don't know. I mean, if you look at it, even IFRS doesn't do it the way FASB does it. IFRS sits there and says you need to look at the nature of what's going on with this and determine if it should be financing or if it should be operating. Because you could have an operating loan and the interest on that would be up in the operating. But if it's a long-term loan to acquire a capital asset, although they don't have a separate capital financing section, they, like the government, stick it down in the financing section of the statement of cash flows. And a company needs to decide which one it goes into, right? So FASB probably got to take another look at that statement of cash flows. They're leaking oil. Okay, let's come over. That's just me talking. I don't know. Okay, let's take a look at number 9. Now, if I was still working for the GAO and we were doing an assignment on that, we would be asking them that kind of a question. Why did you do this? And we would they probably would describe to us some sort of pressures that were put on them by the preparers of the financial statements that they ultimately had to back away from what they would choose to do. So sometimes when you see an irrational decision by the FASB and you're like, why did you do this? If you get behind the curtain, they'll tell you because if we required it the way we wanted to do it, there would be an outcry by the preparer community. And last time I checked, the Business Roundtable and Financial Executive Institute and those sort of groups have a pretty good lobbying influence, don't they? When FASB first wanted to make companies start to expense the costs associated with stock options, at that time in 1992, Senator Joe Lieberman, an independent that ran with Gore one year and then supported Romney the other year, introduced legislation into Congress that said that anytime FASB wanted to add something to its agenda, it had to get SEC approval first. Well, look, if you're supposed to be an independent board that's setting standards, but you have to go to another government agency and say, can we put this on our agenda? You're not an independent board anymore, are you? Okay, so that was a major threat to FASB, and they told us once that happened, we had to back away from our position, right? Then what happened? Then you had the stock option scandal, and then what? Then everybody turned to FASB and said, well, you better do something about this. And they said, okay, how about that standard we proposed, a good 5, 6, 7, 8, 10 years ago? And so, when you read it in your textbooks, it always sounds like the standard setting process is FASB sitting there with their, professorial hats on making all these decisions. Meanwhile, it's a what? It's a somewhat corrupt process to a certain extent, isn't it? Okay. Now, what used to happen was they used to be financed by this financial accounting foundation, and the individuals that were sitting on this financial accounting foundation, they also held not only political strings, but purse strings as well. And so what would happen? You had people like the CFO of GE sitting on the Financial Accounting Foundation, which funded the FASB, which was supposed to be writing standards for big giant companies like GE, right? And what we had recommended at that time is that they fix that funding mechanism. Did they do anything about it? Finally, they did. That report we wrote was in 1992. It wasn't until 2002. What happened in 2002? Sarbanes-Oxley, Enron Sarbanes-Oxley, in which what? Sarbanes required that if you're a public company, you have to pay to play. You've got to fund the FASB to play, right? So, again, these whole things kind of take time to iron themselves out and get a little bit better. But your buddy Bernie Sanders, I saw the other day, and he was sitting there saying, well, they said, well, how come we can't stop fraud with these companies? And Bernie Sanders said, because the whole system is based on fraud. You can't stop fraud because it's based on fraud. What the companies do is they get away with as much as they can. If they get caught, what do? I'm sorry, and they pay the fine, right? So it's part of the business model to go ahead and see what you can get away with. So Bernie Sanders' point was fraud is built into the system. Okay, anyway. All right. I don't know how I got on that. Okay, so number 9, cash flows. And you thought accounting was boring, right? And you're like, yeah, John, you just proved it. Okay, cash flows from capital-related financing activities include which of the following is cash outflows? And that was the one kind of weirdo thing from what? Different from commercial. We put that in financing. Okay. Okay, good. Take a look at number 7. Cash flows from operating activities include the following in inflows. Any cash receipt that does not meet the definition of investing capital or financing, you think? I mean, where else is it going to go at that point? So that's just sort of a catch-all rule, isn't it? I mean, we listed all the other sections there, and if it doesn't go there, then yeah, I guess it better go in operating. Okay? But the point being that what operating is sort of the default, the catch-all, if you can't clearly put it in one of the others. Okay? Okay, good. Number 11, cash flow from investing activities include which of the following is outflows, purchase of what? Investments. You think? You think investments go in investing activities? You think? Okay. Number 12, cash flows from capital and related financing activities include which of the following? Receipts from the sale of an old backhoe that has been used in general government activities. The receipts. That's financing activities. Oh, okay, I could do it that way. What happens if we're doing this for the commercial and we sell a piece of equipment? Commercial. You sell a piece of equipment. That's investing, right? Good. What? When you buy the stuff, it comes out of investing. If you sell the item, the proceeds do what? Go into investing, and then you get stuck with that ridiculous process of doing what? Taking the gain and subtracting it from net income, or taking the loss and adding it to net income, because we've got that cash flow from operating activities, which isn't operating at all, because now it's got gains and losses from investing. From selling of equipment. Okay, all right, good. Number 13, cash flows from investing activities do not include which of the following? Okay, investing, receipts from the sale of marketable securities. No, that's investing. Interest received on bonds, that's going to be investing. Interest received on bonds, that's investing. Transfers to other funds, this is ridiculous, right? This is going to be what? This is going to be more of an operating type activity, isn't it? Aw, that's it? Is that what somebody crying because that was the last question? Okay. Okay, so guys, when you look at the way that Chapter 7 quiz worked itself out for the statement of cash flows questions, and I've already closed the slides, but remember the one that I told you that sort of told you where to categorize different things, and I kind of tested that same thing in a multiple choice format with some of those questions that we chose? Okay, so that's kind of a takeaway that I'm looking for you, is your ability to read a variety of transactions, be able to categorize them in the different areas of statement of cash flows, since my dream was that the CPA exam ended up doing that as well, right? Okay? Okay, good. So let's go ahead then. And let's see. Yeah, I can just continue, right? And then when I post it up on Canvas, I'll just put it under Chapter 7, and I'll just say Chapter 7 and 8 lecture. And even though it won't be under Chapter 8, I think you guys can do the math to realize that it The 8 lecture under 8. Okay. Sound like a plan? Okay, good. So now we are finally to our fiduciary fund category, right? Our PAPI category. Okay. And so we're going to look at let's just go ahead and remind ourselves of our PAPI funds. What are they? Yeah, I know it's PAPI. What are the PAPIs? Agency. No. Permanent is one of the governmental funds. That's the second P in grasp. Private purpose. Good. Good. Right? Whatever. Easy for me to write. So go ahead. Just make it disappear. I know it's going to happen when I die. I'm going to go to hell and they're going to give me a tablet to write on, and I'm going to write on it, and the stuff will keep disappearing, and I'll have to write it again, and the stuff will keep disappearing. Okay. All right. I'll have to spend all eternity like that. Okay. All right. So let's go ahead, and then what will happen? And then the pens will disappear. Okay. All right. So let's go ahead and let's take a look, and we're going to start out. Well, I'm going to talk about the funds in order of PAPI. Okay. But I just want you to understand that what? Our pension fund, our what? Our investment trust fund, and our private purpose trust fund are all considered trust funds. The agency fund is not a trust fund, but it is a fiduciary fund. Okay? Okay, so we come over, and there are two statements that are prepared by the fiduciary funds. A statement of fiduciary net position. The statement of fiduciary net position is what? Like the balance sheet. And what? The statement of changes in fiduciary net position. Anytime you see the change word, it's like the income statement, right? And we looked at some of these way back in chapters 1 and 2, what these statements look like, right? Okay. Now, no statement of cash flows. The only one that prepares the statement of cash flows is what? Is going to be the proprietary funds, right? Okay. Okay, good. Now, you take a look here, and I've shown you this statement of net position, and this is for the pension fund, employee retirement plan, whatever. This is the balance sheet. Notice, guys, that they carry the assets at what? Fair value, don't they? And it makes sense because what? We're going to have to liquidate this thing to pay out benefits at any point in time. So everything should be carried at fair value. Okay. Then what? Then we come over and we have the statement of changes, and we have additions and deductions. Additions are like revenue, aren't they? And you take a look and you have what? Contributions from the employer, which is the government in this case, isn't it? And plan members. Okay. And I think I told you the story about how the cities, and San Jose was one of the bad cities in my opinion, in that they did not put money into the pension for the fire and police for years because the stock market kept doing this thing and they figured it was going to do it forever. And then in 2008, when the market took the turn down, the actuary said, well, now you got to make contributions. And they looked around, they said, we don't have the money to put in the contributions, and it's all the police officers and fire people's fault, right? And I'm like, okay, first you're always kissing up to them, saying what heroes you think they are, and then the minute you got to cough up some money to put in for them, then you want to say what derelicts they are because of these public pensions, right? And so part of their solution was to have what? Have the employees contribute to part of their pension, and that's becoming more of the model. That has been the case in the federal government for years now, where the employees have to kick in a certain share for pension, and then they also combine it with a defined contribution plan. Okay? But these are our additions. They're like revenues. Of course, hopefully we'll have some investment earnings. And then deductions are like what? Like our expense. Good. And of course, we have to pay the benefits to retirees, If someone leaves, we have to refund their money, and then there's administrative costs. And I look at these administrative costs, and I'm like, oh, you mean the administrative costs that you have to pay to these people who made all those poor investment decisions and then all of a sudden said they can't afford to fund the pension anymore? Those people? Yeah, you got to pay them, right? Okay? Okay, good. So you come over, and that's all this. So that's it? I don't get a chance to get out of this? That's it. It just decides. You press this button, and that's it, man. We're going to take you out. Okay? Okay, good. So let's come over and take a look. And GASB gives guidance. And when they give the guidance, it's for both defined contribution and defined benefit plans. Which would you rather have? Which would you rather have? Defined benefit or defined contribution? Huh? Defined contribution says I'm going to put 5%, which they know no defined contribution plan unless it's a government plan. I'm going to put 5% of your earnings into a fund for you each pay period. Defined benefit says when you are 65, I'm going to pay you 60% of your salary for the rest of your life. Which would you rather have? Huh? The defined benefit plan, because what? Now they're going to take care of you. You're going to get 65% of your salary, so quit going to J.C. Penney. I don't know. One time, I was getting on to the BART, and this guy was sitting there asking for money, and then he said, the reason you don't have any money to give me is because you keep going and buying all that J.C. Penney crap. So, like J.C. Penney? Who's going to J.C. Penney? Anyway, so so if you stop going to J.C. Penney, you'll have extra money is the point here, right? So what happens? So you start going to J.C. Penney, you're good in your retirement, aren't you? Okay? Which in contrast, if it's a defined contribution plan, then what? Then they just go ahead and they do what? They put the money in a fund for you, and you got to hope that it grows to a level to carry you through your retirement, right? And more companies, and this has been since the 90s, have gone to defined contribution. One of the few places that you can still get a defined benefit, or at least a portion of a defined benefit, is through public service, right? Okay, but they also have, governments have defined contribution plans, and they really provide their benefits these days through a hybrid of both defined contribution and defined benefit. Okay, I don't know why this ended up down here, okay, but what happens? I don't care about this. All this is the net pension obligation. Okay, net pension obligation is basically the amount that is not funded yet in this pension. So if you look at the liabilities of the pension versus the assets of the pension, the difference is going to be considered this net pension obligation. Now it shows up. What is this? Okay, so what I wanted was this red part. That's why I couldn't figure out what this bottom part was. This red part is the part that I wanted you to understand, in that when one of the governmental funds goes ahead and pays the pension benefits for their employees, if it's a general fund, what journal entry do you think that makes? So I'm in the general fund. I'm going to make a contribution to my pension fund for my police officers. What journal entry should I make? I'm putting cash into the pension fund. Huh? Debit pension fund? You want me to debit a whole fund? Well, can you figure out the cash? I mean, the credit? Credit cash. Okay, so we're going to credit the cash for 100,000, let's say, whatever our contribution is. What are we going to debit? No. This is an expenditure. Think of it as a portion of their compensation, isn't it? So if I asked you that same question for salaries, you would know to debit expenditure, wouldn't you? Right? So since this is part of their compensation package, we debit expenditure. That's the key thing I wanted you to know. When the contributing fund makes a contribution to the pension fund, it's what? Debit expenditure, credit cash, right? What happens in the pension fund? Journal entry in the pension fund. Good, good. Take the low-hanging fruit, debit the cash. Good for 100,000. Good. What do you want to credit? Okay, but what do we call revenues? No, that's for the internal service funds. We call it additions. Good, right? That says additions for 100,000, right? Okay. Okay, good. All right. Have to report trends and NPO. NPO is what? Net pension obligation. It's the unfunded portion of this pension, right? Unfunded portion of this pension. Okay. All right. Agency funds. Okay. And remember, guys, we said last time that if the what? If the government is not potentially primary liable for that special assessment, we account for it in the agency fund. With the agency fund, the government is doing what? Acting as an agent of some other entity, right? Okay, so if we're just holding the money and going to disperse it to somebody else later, that is considered an agency fund transaction. If the government is potentially primary liable for special assessment, that gets accounted for where? We're building streetlights, capital project fund, and then the payment of that debt gets handled in the debt service fund, right? Okay. Okay, good. Now we come over, and that's my timing is a little off on the slides here, and what I'm saying, what I wanted to point out on this slide, on the last slide. Okay, if the government is not potentially primary liable, it gets accounted for where? Agency fund, right? Okay. Okay, good. Now you come over, and we have different types of agency funds, and one is called a pass-through agency fund. And with the pass-through agency fund, money is just passed through that fund, you think? So what happens? Let's say that I am the state of California, and I get food stamp money from the federal government. The state of California will take that food stamp money and give it to who? Give it to the counties, right? Okay. So the state fund that handles that money that's being passed through from the federal government to the counties would be a pass-through fund. Okay. So you're starting to get a sense of what these agency funds do, right? Which is what? They get money, they hold it, they really don't have any responsibility for it other than to do what? Hand it to somebody else, right? But they don't really do any sort of operating activity with that money at all. They hold it and they do what? Give it to somebody else, right? Okay. So you take a look. I want this slide. Let's take a look at a tax agency fund. Does this look complicated? Okay, let's see what this tax agency fund does. Okay, so let's say you have a house. What's the greatest city in the world? Hayward. Okay, good. So let's say, very good. You have a house in Hayward. Do you have to pay property taxes on that house? Even in Hayward, they make you pay property taxes. Now, when you pay your property taxes in Hayward, you don't pay it to Hayward. You pay it to Alameda County Tax Fund, Property Tax Fund. Alameda County property tax collector. So you take your $1,000 of your property taxes and you pay it up there. Now, in Alameda County's agency fund, they're going to debit due to, who does this money belong to? They're not going to debit due to Hayward. Come on, John. Why would they debit? No, it's not due from. They got money, didn't they? So they're going to debit what? What do you debit when you receive money? Cash. They're going to debit cash for $1,000. And they're going to credit, right, which is like a payable, due to Hayward. They're getting Hayward from the property owner in Hayward who owes money to Hayward, but they're paying it to Alameda County, right? So they debit the cash and they credit due to Hayward, and they credit due to Hayward for $980. So they owe Hayward $980 of that money. So that means that 20 of the dollars aren't going to Hayward, right? Right? So the $20 they will credit due to, what's AC? Alameda County, what's GF? Not girlfriend, it's general fund, right? So it's due to Alameda County's general fund. So the agency fund is still going to pass that money over to its own general fund, and that is used then to finance the cost of this collection activity and this accounting activity, etc., as they collect these funds and ultimately disperse them to the cities, right? So again, what does the agency fund do? It takes money, it holds it, and it says, here, you get this, Hayward. Here, you get this, Oakland. Here, you get this, Fremont, whatever, right? And here, general fund, here's some money to help finance this whole activity, right? So they do not have an operating account, do they? They are simply a balance sheet of money coming in that is due to somebody, right? Okay? And so if you look at the financial statement, there's the pass-through. We described that. If you look at the financial statement, just a balance sheet. Just BS. And you're like, no kidding. Right? Just a balance sheet. That's it. It's cash, and it is due to somebody. It's a liability, isn't it? Right? There is no operating statement. There is no statement of revenues, whatever. Nothing. Just a balance sheet. No income statement. Okay? Okay, good. Let's go ahead then and let's look at our trust funds now. And again, remember we have what? Investment trust fund, private purpose trust fund, and the pension. We've already talked about pension, haven't we? Okay, so now we just got to pick up the investment trust fund and the private purpose trust fund. So let's go ahead and look at the investment trust fund. Okay, just going in order of PAPI, pension, agency. I can't spell PAPI, right? Okay, so this is not in order of PAPI. Okay, so I thought I fixed it in order of PAPI, but apparently I didn't. I'm trying to figure out what this is. This is PIOP. Okay, so, PIOP, okay. So what happened? We're sitting here and we have the investment trust fund, right? What happens with the investment trust fund? Well, now I'm sitting here and I'm the city of Hayward and I have a T-bill. I have a T-bill. And I'm sitting there with that investment, and one day Fremont calls me up. And Fremont says, hey, we got an idea. Let's pool all of our money into one investment pool, and that way we'll save money on brokerage fees and that kind of stuff, and we'll just pool our funds together, right? And we're going to do this as the Alameda County Investment Trust Fund. And Alameda County will handle this for us and take care of this for us. So Hayward says, sure. They go ahead and they give their money. Okay? Now that's a pooled investment. Okay? Now what happens? Even though they'll account for that all as one pool, okay, and so they're going to do what? They're going to distribute gains and loss proportionately to which each city holds of that pool. The investment trust fund only reports the assets that it holds on behalf of other entities. It does not sit there and what? And report its own share of the pool in the investment trust fund, because it's a trust fund. It's what? Those outside of the government. So that their own investments would be accounted for what? In whatever fund held that investment, say the general fund, whatever it is, right? Okay? And even though they would pool the investments, and gains and losses are calculated proportionately. So you come over and you take a look at this little example here where we have our investment trust fund. We have Hayward, Union City, and Fremont. And then Alameda County has its own T-bill too, right? Now you look, and Hayward has a T-bill, and Union City and Fremont each have corporate stock. So if you look at it in terms of shares, Hayward has a 50% share, just looking at the proportionate shares. Union City and Fremont have 20%, and Alameda County holds 10% of this investment pool, I should say, right? Okay. Now, if you look at the balance sheets now, after the T-bill and stuff are given to the investment trust fund, now Hayward doesn't report a T-bill anymore. They report what? A $500,000 share of the Alameda County Investment Trust Fund. Fremont shows their $200,000 share for their stock, and Union City shows their $200,000 share, right? Okay. Now, this is where this is the important point. When we get to Alameda County, they're going to report in the investment trust fund what? Only those assets that belong to outside entities, aren't they? Right? The Hayward T-bill for $500,000, and the corporate stock, the 200 from Fremont and the 200 from Union City, whatever, that's reported in the investment trust fund. The $100,000 T-bill is not part of the trust fund assets. It is what? It is sitting up there in and I'm assuming the general fund was the one that held this investment. It's still on the balance sheet of the general fund, isn't it? Right? Okay, so that T-bill is still reported in the investment trust fund of the investment trust fund, but that T-bill is still on the general funds of the Alameda County, right? And in the investment trust fund, it's only those that are held by Hayward and Union City, right? Right? Huh? In Fremont, yes. It's Fremont too. Sorry. You from Fremont?
Well, I used to live there.
Oh, okay, sorry. Well, then you're really not going to like this next slide, okay? All right, because what happens? Remember, they've pooled the investments, haven't they? So, and we said that in the pool, gains and losses are what? Handled proportionately? Actually, if you're from Hayward, you shouldn't like the next slide. Okay, because what happens? Notice I had Union City and Fremont lose all of the value of their stock. So the $200,000 for Fremont, the $200,000 from Union City dropped, right? And they lost all their value. Maybe it was Enron stock or something. I don't know, but it lost all its value. So these are now zeros, aren't they? Okay, so we've lost $400,000, haven't we? Notice that what? Hayward has to absorb 50% of that loss, don't they? Because they counted for 50% of the whole investment pool. And what? Union City and Fremont only absorbed 20% because that was all they held. And Alameda County only has to absorb what? 10% of that loss, right? So when you get to the financial reports, now what happens? They are showing in the investment trust fund the $500,000 amount of a T-bill that they have, right? The corporate stock, I mean, they probably wouldn't put zero. They would just take that line item off the report because those are zero now. And now, because the T-bill is still sitting in the general fund of Alameda County, they're going to, what, have to put a due to the investment trust fund because they owe them $40,000 for their share of the loss. And at some point, if what? Hayward said, hey, I'm done with this thing, man. Give me my money back. Well, they only owe Hayward how much? $300,000 now, so they'd probably say, okay, and maybe go ahead and do what? Cash in the T-bill and give Hayward their money, and I don't know, keep the rest of the money or give it back to Alameda County, and eventually they're going to be $40,000 short on this thing, aren't they? And so they'd have to probably sell their T-bill to liquidate to give the $40,000. Okay? Now, the two takeaways from this example is we pull the investments and gains and losses are what? Handled proportionately, aren't they? And the other takeaway is what? The investment trust fund only keeps track of those assets that it is holding for those outside of Alameda County, right? Right? Is Hayward Alameda County? Well, it's in Alameda County, but it's not Alameda County. Hayward is its own government, right? Alameda County is Alameda County. Fremont is Fremont. Union City is Union City, right? Hayward is Hayward. And so since they are not Alameda County in the investment trust fund, we only had what? We only had their investments, right? The T-bill held by Fremont is in Fremont's general fund. Right? Hello? Okay. Okay, good. Private purpose trust fund. Okay, what happens with the private purpose trust fund? Private purpose trust fund is set up to account for assets that are being held for some sort of private purpose, like individuals or an organization. And I give you an example here, okay? Just looking at private organization, college fund for cops kids. What happens here? A lot of times police officers get slain in the line of duty or whatever, and now kids got to grow up without a parent, right? And so often a not-for-profit will be organized that will collect money, and it usually starts with one officer, and then something happens to another, and they create a not-for-profit to handle these kind of sad situations, right? At some point, the contributions coming in are so significant that it's really more than the not-for-profit bargained for. They're just not equipped to handle that sort of funding, right? So what happens? They go ahead and they turn around and they say to the city, will you handle this fund? City looks at that and says, sure, we'll help manage that. We want to help the police officers, etc. So they do what? They are holding funds that belong to who? Belong to that not-for-profit, belong ultimately to the police officers' kids or something, right? Now you're seeing a theme with these fiduciary funds. Every time it's what? We're holding money that we're saying actually belongs to somebody else. You're saying, well, what about the pension? Well, those pension funds belong to the employees, don't they? Okay. If you guys want to go watch the game or something, is that what's going on? Or is there a game on or something? Okay. Because you keep looking at his computer, so I'm thinking you guys got the game on there. Okay. So what happens? What time? Did the game tonight? In Cleveland. Oh, okay. Because I keep seeing him look at yours, and you're wearing a Cleveland hat, and he's wearing a Metallica hat? Oh, Warriors. Okay, I thought it was Metallica. Never mind. You guys don't know who Metallica is. Okay, so what's happening? You guys know who Metallica is? Oh, okay. I saw Metallica in a club in like 1980, about the size of this classroom. It was insane. It was crazy. So anyway, all right. So what's happening? You sit here, and what were we talking about? The theme of the trust funds is what? Sorry, guys. The theme of the trust funds is what? Focus, John. The theme of the trust fund is going to be what? Is going to be to sit there and hold money that belong to others, right? Or all of our fiduciary funds? Okay? So now we're holding money for these officers who have been slain or whatever, and we account for that in a private purpose trust fund because it's a private purpose, isn't it? Okay. Now, we also have this escheat property. Escheat property is unclaimed property. What happens here? So, let's say your grandparents, your grandmother gives you $500 for your 5th birthday. right? Makes sense. $100 a year, right? Give the kid $500, right? Your parents look at that and they say, we're not letting a 5-year-old have $500. So they say, we're going to teach savings or whatever, and they open up a savings account for you, right? Okay. Now, you put that money into the bank. You come over here to San Jose State. You make all kinds of, you get good grades. You go get a good job. You make all kinds of big money. And you forget about that $500 that was sitting in the bank, right? Can the bank keep that money? Can Bank of America just keep that money if you never come and get it? What are they supposed to do? They're supposed to come and find you. They're supposed to find you. But that gets kind of hard, right? You could be anywhere. Okay, so ultimately, they hand that money to the state of California. And now it's the state of California's job to come in, find you, right? Do they? This is what they do. They go ahead and they put your name on a website. It's called the Unclaimed Property website, state of California. They put your name there, and you are going to need to go onto that website, and you're going to have to type in your name and the city that you lived in at the time that you think you lost that money, and you may get a hit. And if you get a hit, they'll say, fine, you have to give us 3 proofs that you are who you say you are when that money was lost, and we will send you that money in 6 months. Okay? So you go in 180 days. So you go in and you put in your name, and it will return back to you whether or not that money, whether or not you can get that money. Now, I would tell students as a joke to go ahead and try that, and when you do it, to put in my name as well. And I have now twice have students come back and say, John, you have some money. Okay, so one time I had I think it was like $50 or something. What happened was I sold a house, and I had the insurance in an impound account where the insurance company automatically takes out the insurance portion. And the insurance company couldn't figure out that when I sold the house and they cleared out the impound account, that maybe, and it was the same insurance company for the new house, that maybe they should forward the money to the new address. They couldn't figure out, where is he? He's not here anymore. And so they went ahead and they did what? They tried to find me, and then they finally sent the money over to the state, right? Okay. Then what? My student found that, said, hey, John, you got $50. The next time, it was $900. Same deal, the insurance company trying to get me some money, right? So now what I do, around holiday time, I go in and I put in my brother's name. And if he's there, I say, hey, here's your present, right? You got it. And he had $50. And then he couldn't figure out how to claim it. And he's all, well, I tried. At least I tried. I'm like, okay, you need to claim that money. What's wrong with you? That's $50, right? Okay. So he couldn't claim it. One time, I got a letter in the mail from a CPA firm saying, we can get you that money. And I'm like, that's stupid. You just go and you fill out the form. You don't need a CPA firm to do that for you. You fill out the form. Unclaimed property. State of California, huh? Yeah. Oh, yeah, they can't keep it. They cannot keep it. There's no statute of limitation on that. That is your money. And they sit there and they hold it in this private purpose trust fund, right? For the most part. Now, how many people do you think know about this? Not very many. So for the most part, nobody ever comes to them for the money. So for the most part, the state does what? They just spend the money because they know that nobody's going to come and get it. Now, what they do in the private purpose trust fund is they estimate, almost like the inverse of an allowance. They already have the cash, and they estimate how much the claims are going to be, and they set up a liability for what they think the claims are going to be. But the rest, they just go ahead and spend it, don't they? So since they spend this money so freely, take a look at this. As a practical matter, a substantial portion of estate property will never be reclaimed. In light of this fact, governments typically retain only a portion of the resources to pay what? Anticipated claims and use the balance in their operations. They sell it. They spend it, I should say. And then what? In that case, a liability in the fund equal to the amount ultimately to be paid out to claimants, and recognize the balance as what? As simply revenue. And I thought I had up here. I guess I don't. Oh, is there one more? On the next slide? Oh, one more bullet? Oh, okay, there they go. Thank you. Governments frequently elect to account for its cheap property what? In the general fund because they know they're going to spend it all anyway. So they just bypass this stupidity of, putting these amounts in the private purpose trust fund when nobody's going to come and get it. Okay?
Is it kind of accounted for like the allowance for uncollectibles?
Well, I said it's the inverse. They already have the cash, and they do what? They take a revenue for the portion that they think they're going to keep, and they set up a liability for the portion. It's a liability as opposed to an allowance, but they have the cash already. So they use it as a liability for the part that they think will be reclaimed. Okay? Private purpose trust fund. All right, good. Let's go ahead then. Beautiful. Timing is perfect. And let's take a look at the quiz. Okay. Ready? So Wadsworth County maintains an investment pool in which it invests funds for Wadsworth County and for all legally separate school districts in the county. When it reports assets and investments, trust fund statements of fiduciary net position, whose assets should be reported in the investment trust fund? And it is what? Only those for the what? Guys, I'm not here to read something that you can read. Only the what? Only the separate school districts because what? They are separate entities, aren't they? Right? Okay. Okay, good. The city of Albertville invests assets of several neighboring cities through its investment trust fund. What account should Albertville credit when it receives money from the neighboring cities for investment purposes? It is what? Additions. Okay, and it's additions contribution from city, I guess. I don't know why this is different than the other ones. I'm not asking you this. We didn't get to this level of detail because they have 3 additions. I thought it was just additions. I'm not asking you that question. We didn't get to that level of detail. Now I'm trying to get into specific types of additions here. It's certainly not revenues. If I'm giving you this question, I'm going to take away 2 of these additions and call them something else, right? Okay, because I don't care about this level of minutia here. I don't even know who wrote this. Who came up with the stupid question. Okay, which of the following resources should be accounted for in a private purpose trust fund? Dormant bank accounts that escheat to the state with laws requiring the resources be held in perpetuity for the rightful owners? Right? Number 4, which of the following activities of government should be accounted for in a private purpose trust fund? Money for police officers killed in the line of duty. The primary financial statement of a government-sponsored pension for all of our what? Fiduciary funds. It's statement of fiduciary net assets and statement of change in fiduciary net assets. So that one slide, guys, that names all the names of the statements that we had back in whatever chapter it was is still haunting you, isn't it? Remember I had all the names in red? Okay. Okay, good. Citizens with defined geographic area create a special assessment district to facilitate the construction of sidewalks. The city is responsible for overseeing the entire construction project. The city issued bonds in its own names to pay the contractor for the construction. However, the city was not responsible in any manner for the bonds. And I don't know how they exactly pulled that off, but okay. If that's the case, we account for that where? Agency fund, right? Was the key phrase there? Okay. The key phrase there was what? Not responsible in any manner? Okay, good. Number 7, financial assets reported by most investment trust funds of government should be reported at Investment trust fund, we got to use what? Fair value, obviously. Okay. Which of the following is not true of agency funds? They do not use modified accrual. They use what? Full accrual. Okay. Question? Okay, so you see when we get into these last couple of chapters, we don't have a lot of calculations. We primarily have what? Do you understand the nature of the type of things that go on in these funds? That's more what we're trying to focus in these last couple of chapters for our enterprise, our proprietary funds, and our fiduciary funds, right? Okay. Now, we have one more sort of thing that we're going to, that goes beyond just concept, going to require some calculations. That's going to be the reconciliation. This is not the time for us to start that. Okay, so what I'm going to do is I'm going to go ahead and put up some reconciliation questions. I'm not going to have slides for the reconciliation. I'm going to simply walk you through the process, and then I'm going to walk you through the questions. We'll do that, and I will put up a practice midterm up there, and we'll go through that next time as well, right? And that should have us in good shape for the midterm. What I would suggest you're doing this weekend, since you're coming up on the test and stuff, right on time, right on cue, is to start to go ahead and take a look at some of the practice midterms for chapter 5, 6, these ones that we did today, 7, 8, and see if you have issues, questions that you want to be thinking about. And then you can do that as well, obviously, with the practice midterm that I'll be putting up probably towards the end of the weekend. Okay? All right, guys. I will see you next week.